Very happy to have with us the experienced and talented team from Solutions Financial Services today. So we have Kevin and Jess, you'll see in one window, and then Luke is joining us from another.
Yes.
They all are related, and as you probably guessed, I know it's hard to work out, but Kevin is the oldest. And and so Kevin, you've been in the industry for 35 years, right? You must have started when you were 5. Yeah,
4.5.
4.5. I'm sorry, my apologies. And then Jess and Luke, you've been in the industry for 4 years, correct?
Yes.
Yes.
Great. Well, thank you so much for joining us today. We have, I guess, some things we thought would be good to run through. Firstly, insurance in 2022. What is it that people need to know? Because we've got a whole lot of risks that weren't present, or maybe they always were present, we just didn't think about them. The average person and a couple of years ago, how can we de-risk ourselves? It'd be good to talk about business owners. What should they think about? What about this new scheme of the government for redundancy or unemployment insurance? I've only scanned the article. And lastly, any final tips and tricks. So those are probably the 4 things we're hoping to extract from you today. But maybe just before we get into that, historically, I remember growing up, insurance people would come and knock on the door. I'm probably showing my age, right? Nobody does that anymore, just about. But insurance agents had a bad rap. But Solutions Financial Services are not per se insurance. What is the difference between risk advice and insurance? Could you just clarify that for us first?
If we go back to the 20, 30, 40 years ago, the industry was made up of pretty one-dimensional contracts, or full solid life and endowment contracts. And there are people who still think that there is a place for them. But in the modern world we live in, dying is one issue. So is being diagnosed as having a heart attack, so is being off work, so is now covering medical insurance. So a risk insurance guide is more about analysing the risks that individuals face, looking at statistical chances of them happening, and then putting tools in place to either mitigate that risk or reduce that risk based on the circumstances where those people are in their lives at that time. And everyone's on a different journey, and everyone has different beliefs. So a good risk enforcement guy will spend time with someone just basically saying, where are you, where do you want to go, how do you want to get there, and what's going to stop you doing it, and how can we minimise that. And insurance is only one of the tools.
I'll just add to that as well. We sort of take a more holistic approach to people's financial advice. So basically, the way that we try and position ourselves is sort of the middle, the orchestrators, really. So insurance is obviously one part, but then there's also estate planning, there's accounting that people need to get sorted, and there's a bunch of other parts to it as well. So we sort of sit in the legal side. So we sit in the middle and we try and map out people's plan with them, and so we're sort of helping guide them in a few different directions, and then providing the insurance advice piece as well.
I can give you a really blunt example. Only about 50% of Kiwis have a current will, and 90% of life insurance policies are owned by themselves. So if they die, the money goes to them. Right?
Or their estate.
Or it doesn't work. And then, so the money goes to them. You've now got to go through probate, and that can be anywhere up to 2 years on a simple case to get money to the person that needs to go in the first place. And that's just because 2 documents were not aligned. That's risk management.
And adding to that as well, kind of back then, knocking on the door, it was more of a kind of like a forced sale as well. So it'd be like, do you have life insurance? Oh, no. Well, you should probably get some because you need some. You know, what's your family going to do? If you don't have it, who's going to pay for your funeral and blah, blah, blah. We're now, especially in our business, it more comes from referrals. So we kind of get referred to clients. We go through, and as Jess said, we do a proper holistic process and look at everything. So when we do whether we put an insurance plan in place or whether we don't, it matches their situation. We make sure that it's something they can afford and it gets reviewed regularly rather than just something that's put in place. And then they go, oh, I've been paying for this life insurance plan for 20 years and I forgot that I had it. So, yeah, it's a little different in the way of we sell, the way you sell, and then the way how you look after your clients as well.
Mm. Okay, well, that makes sense. And I know certainly that was our experience, which is why we wanted to sort of get you talking to, as it were, to hopefully a bigger audience, because you don't know what you don't know. Often you think, oh, well, I think I've got income protection insurance, but often it doesn't always do what you think it will do. And so having experts who will come and help connect you to the right people, then you do end up getting, oh, well, this is, I need this product, not that one.
Yeah.
So I guess there's a little bit of inertia as well too, which is, I must get around to that. And hopefully if you're watching and you haven't got a will, this is a little push around that whole thing, as that comment that Kevin and Luke had just made. So here we are now in 2022. We're a couple of years now into the COVID pandemic, and variants keep rolling out like flavours from an ice cream machine. People are facing different challenges. The borders are opening up, I see mentioned in the news today. So we're going to have a lot more people coming into the country. Inflation on the up. What do people need to think about in terms of de-risking themselves with their personal insurances?
From my perspective, I think people just need to take a really hard critical look about where are they going, what are they doing, what are they trying to achieve, what's most important to them. Because a lot of the times we catch up with people, they're over-insured. They took their policies out 5, 10, 15 years ago, but their houses are now. I think one of the most important things people need to do is just really think about where they are in their life. What has changed? Have their kids grown up? Have their mortgages changed? And everything is so fluid. If we took someone, say, 10 years ago and said you've got $600,000 worth of mortgage, well, that was a bloody big mortgage, but $600,000 now compared to the property, that might only be 25% of the value. The kids are growing up, they're both working. And the question is, and people think that if I die, I've got to get rid of all of the mortgage. Well, do you? If you're going to downsize and move away, or you've got money sitting in KiwiSaver, all of those things need to be taken into consideration. And you've just got to right size them. And a lot of clients we come across, we just find they're spending money because they've just done it for the last 10 years. The premiums have gone up and up and up and up, and they just don't need that level of cover or that the way it's structured. So just thinking about it, and it doesn't mean changing insurer, it just means reducing your cover or right-sizing it to where they are at the end of the time. And you've got to remember, risk insurance is something that you rent. You don't own it forever. Our job is to help our clients protect the risk along the way, but also show them what to do with money so that when they are 65, they have self-insured. That's what a good risk guy does. So.
Now that is, I must admit, the opposite of what I expected you to say. Because I'd expected that, well, as time goes by, you're going to need more and more insurance. In 2022, it's riskier than it's ever been insured to the hilt. And instead, it's like, actually, it could be the other way. So that's very surprising, very refreshing to hear. Oh, okay. I guess this is the value of consulting with risk advisors, isn't it?
Yeah. We met a client the other day. Their property is worth, $4 million. They've got $1 million worth of debt. If either one of them die, they're going to bugger off and go down to the beach house, and then they're going to have $3 million to invest when the mortgage is paid off. Why do they need insurance? Kids are growing up, all sorted themselves out. What do they need insurance for? They've got enough money now to retire. The challenge for me is trying to get them to retire.
And also we find some clients as well, they don't want to let their insurances go because they, as Kevin said, they have been paying for it for a long time and things like that. And so we
see it as an investment, right?
Come in, they see it as an investment, and we come in and we ask these critical questions about, their life and what decisions they would make if something happened to them. Would they sell the property and downsize, or could they sell an investment property and things like that? So it's about thinking more holistically about it and not just thinking, if I die, I want to pay 100% of the mortgage off and things like that. So we're trying to think of sort of more realistic solutions so that people don't end up spending thousands and thousands of dollars on insurance. We're trying to, figure out the best solution for people individually relating to their set of circumstances.
Yeah. Well, I guess adding to that, Jess, is see a lot of clients, they may have a small amount of trauma insurance, but when you're 65 years old, sorry, is my connection unstable now, or can you hear me okay?
You're coming through nice and clear, Luke.
Okay, perfect. Going back to that, when you're 65 years old and you have, say, $20,000 of trauma insurance, it's actually a really expensive product to have, and it can cost anywhere from $5,000 to $7,000 per year. So at that point, having those conversations saying, do you actually need that amount, or can you set up a savings account or a managed fund or something like that where we can start to build wealth rather than spend it in that kind of situation. So yeah, it's all about having those appropriate conversations, and if they do need it, they make that decision rather than us saying you definitely have to have this product.
So one type of insurance which we think is definitely necessary, especially heading into another year with COVID, is private medical cover. So obviously all insurances can be important for different people, but private medical is something which is becoming more and more important for people to have just because of the current state of our public healthcare system. I think 19 out of 20 DHBs are failing to meet their targets. A lot of public elective surgeries have put on hold because of COVID. So, and wait lists are just becoming longer and longer because of that, public wait lists. So, I think, private medical is something that if you can afford it, you should definitely look into it sooner rather than later. The younger that you get it, the better, because you won't have as many pre-existing conditions as well. And it's something that a lot of people keep forever, don't they, really, if they can.
Be a little bit more blunt about it too. Putting someone in a hole is like $15,000 to $20,000, and it's a month-off cost. Putting someone in a hospital and keeping them there for the last 14, 15 months of their life can be $15,000 to $20,000 a month in treatment cost. And so, the cost of getting someone to the hole is probably more expensive than actually digging the hole and putting them in a box. So, and one of the ways we're helping our clients manage their medical insurance is look at the excess options, because you can increase the excess options where we've come across people that are retired and their medical insurance is now $1,400 or $1,500 a month for them, but they've got a really small excess. They've got a couple of $100,000 sitting in the bank. If something goes wrong, they can always find $2,000 or $3,000. What they can't find is the $8,000 per fortnight for the non-pharmac drugs. For the next 15 years. I think that's important.
Yes, non-pharmac's the other big one as well, which obviously that can be hundreds of thousands of dollars a year, which is not covered by the government. So, a lot of the top medical policies have a few $100,000 built into their contracts of non-pharmac cover. So that's also something else that people should look into if they're considering medical insurance. They need to look at the fine print. Make sure they know what is and isn't covered and the limits of things as well, because it does differ immensely across the industry.
It sounds like one of these things where having a professional to help guide you and navigate you through this is a must, because sometimes it's the fine print that catch you, right? You think you're covered for this, but actually you're not. Yeah. And I think there's some interesting comments here that come out. View your insurance as like a rental, not an investment. And that's the point that you're kind of trying to manage yourselves out of a job, aren't you? So that by the time, as you said, Kevin, a person's getting to retirement, that they've got other resources, because you get to a certain stage and no one will insure you anyway, right? Or the insurance has run out, or that kind of thing. So hence, it's just clicked after all these years. Hence why the name is Solutions Financial Services. You really are trying to provide people with solutions. It's not just a gimmicky name. It's what you do.
Yeah, well, we've got 3 generations of clients that are with us, and we know our clients are getting to the other end, but we're introducing them to their kids and their grandkids. So part of the reason why we're here as well too. We have a very sustainable business, and the better we look after our clients, the more referrals we get. I think there was another point that I think we do need to touch on as well too, is that you only know what you only know. In our world, we have probably close to 2,500 or 3,000 product combinations that we use. And So we see a lot of people that are going to go online and try and choose a level of cover that they think is appropriate. And I sort of create the analogy, if you went and bought a brand new car and someone gave you a workshop manual, are you capable of pulling the engine apart and putting it back together to start it? And the answer is no. So, the amount of knowledge and the amount of testing that we have to go through and the accreditation process we have to go through to keep our processes up with all of the insurance companies is just horrendous. But there is just there's so many differences and little nuances between policies where people think they've got a policy that's going to pay them $7,000 a month if they go off work, and some do and some don't, and it's all to do with the offset clauses. So there is a lot of data behind it. So yeah, you've got to know your way to navigate. So someone going online and thinking they can do what I can do without 35 years of experience is, I don't know, trying to do your own accounts, I suppose.
And I guess like going through an advisor, clients don't pay more for it. So we do get paid commission through the insurance companies. So it's a free service. However, the renewal commission that we now have to disclose, which is great, is used for us to service those clients. So there's an ongoing requirement for us to make sure that whatever we put in place is still fit for purpose, and that as things change and people buy properties, change jobs, get into new relationships, that insurance package is still suitable.
Okay, so that's good to know. So in other words, when you get your policy, you'll see that it's not more expensive having yourselves as risk advisors, because you would have paid that anyway. Instead, you're able to just sort of, I guess, buy it at wholesale, add your commission. So the end result is you get the advice and essentially the cost is the same, but you get a better service or product for it, or better rental, should we say, for it.
Yeah.
Essentially, I believe there are some situations with, I think Life Direct or something, where you may get a cashback or something like that. But more or less, it's no more. It doesn't come out of a client's pocket as an extra fee for going through an advisor.
Well, some advisors charge fees, but if we were just doing an insurance review and helping with someone's sort of, just doing a general plan for them, we probably wouldn't charge for that. We just paid a commission. But I mean, I think the difference between us is we're not looking for new clients. We take on clients that we're referred, but we're not out there trying to find 10 new clients a week. So yeah, basically I think we're just, we want to help the people that come to us, and we'll do the best possible job that we can do, and we'll provide them with a plan that's appropriate for them. And that may mean that they're, we tell them to reduce their existing covers, or we say, maybe you could look at self-insuring or something like that. It doesn't always mean they have to go and take out $500 a month of insurance. It really, we do try and find the best solution possible for those clients at hand.
We appreciate you actually demystifying some of this too, because I think there is a bit of a starting from the back foot. Accountants, we have a little bit of a trusted advisor position in the minds of most people, but probably other industries don't always have that necessary advantage. So I think in some ways it feels like, a curtain's being drawn back and the light's being shone in, and actually there's no skeleton in the closet here. It's all very open and transparent.
Yeah.
Well, the industry is fixing that because, this year all advisors are going to be licensed and they're all going to have qualification criteria. So I think that's a great step as far as the industry is concerned. So those that are in it have to now bring their education standards up and their licensing standards. Where in the past, it was people come in and following day go and set up. So the barrier to become an advisor is a lot tougher these days, and I think that's great for the industry. One of the most important points that I can probably pass on to anyone is, and this is what happens to claims time. Right? So we all pay a premium, hoping like hell we never have to make a claim, but if we do need to make a claim, what's going to happen is that the insurance company's going to ask us to do anything else. That's what happens, right? If there is anything in your medical notes which is different to what you put in the application form, it's called non-disclosure. And this is a big issue that the industry needs to actually get better. and clients need to be made more aware of it. If the medical notes match what's in the application form, there's never any problem. We get claims paid out straight away. If there's some glaring issues in that, it just makes the process go really, really slow. And what we found out over the years is that quite often when you go and see your doctor, they will put notes in your file that you don't know that they've written, especially around things like mental health. You come in and said, Jessica's been incredibly stressed today, so I think she's under this mental issue. And so if that happens for 2 or 3 years in a row, if Jess then doesn't put that in a medical note, or
in my application
form, you end up with this difference in there, and then suddenly when it's claim time, Jess is putting in a claim for being off work with a stress-related issue. Suddenly you've now got this clash. And so one of the best things you can do is that when you are either replacing an existing contract or taking out a new contract, get your medical note and make sure that you know what your doctor has put down about you. And you're allowed to pick up a free copy every 12 months. You can say, can I have a copy of my doctor's notes, please? And they have to give them to you at no charge.
Now that's useful to know, so you can review them and make sure. And I guess even sometimes things you might forget. I didn't even remember that happened, but it's in your doctor's notes.
That is so common. That's you're exactly right.
Jess,
the sorry. Way of doing it, if you give those medical notes to the advisor so that they can pass them on to the insurance company, there is no issue with non-disclosure. So, do you need to do it every time? Like in real terms, someone cutting their finger or doing something like that is not going to have any implications in contract. But if someone had chest pain and they forgot about it, and 3 years later they take out medical insurance and they're part of that, we know we're going to have a problem.
Just touching on that, Jess, correct me if I'm wrong, but we know someone who went in and same thing, requested their medical notes. She then said, look, this is actually not the case. I don't know why you've written this. And then she said, could you please change that? And GPs can't actually change them. They can add a new file note and say this is no longer the case, or I misread the situation, but they cannot actually erase what they've written as well. So that's just something to be wary of when you go in there and start talking about.
You are correct. They can't erase it, but what they can do is resolve it.
Yeah.
As long as the issue has been resolved, and it's not an issue ongoing, you can't exclude something that's been resolved.
Wow. Okay, that's super useful knowledge to know there. So thank you for sharing those tips. We've kind of moved through some of the things that we said we wanted to talk about, which is great. What about key person insurance versus ACC, CoverPlus Extra, and businesses? Is that a thing? Is that something? Should business owners worry about that, or is that a little bit over the top? Any thoughts on how that all works?
Huge subject, and how long have we got?
We have as long as you like. Yeah, yep.
Let me just nail a couple of things that I think about. Anyone who's self-employed should be on CoverPlus Extra. There's two types of ACC, CoverPlus Extra. They basically cost the same. One is an agreed value contract. One you have to prove your loss of claim time. Now, from a self-employed perspective, trying to prove your loss of claim time, you're going to have to spend $10 billion with Gareth bringing your accounts up to date, so that the insurance company can make an assessment on it, so that becomes a nuisance. You might as well just get the agreed value contract from ACC, and the advantage of CoverPlus Extra, you can choose the level of compensation that you want within boundaries. But CoverPlus Extra for self-employed, number one is up to you. The next question you asked was about key person. Most small to medium-sized businesses in New Zealand survive and rely on either one or two or three people that make them tick. If you take them out of the picture and you take the head off the business, they generally fail. The discussion around that, if that business is going to fail, what are those costs going to be? What's the cost of actually getting out of business, or what's the cost of getting somebody in to maintain that business to see whether that person is going to come back or not? And so putting policy place, if the business had a widget that was worth $500,000, it would insure it. But if it's got a widget that generates $500,000 a year because of the sales they create, if you take that engine away, you don't get the sales. So this is where a business just needs to look at it and say, are my people assets? And if they are, they should be considering insuring them as a key person.
Okay, so it sounds like something that a bit of a no-brainer in some ways, right? The CoverPlus Extra and then key person insurance. I guess if you're doing that, then you are to a degree fixing what your costs are and covering yourself not just against accidents but sickness.
Yeah.
Well,
yeah.
It
Well,
also can be death too. You know, if the person if you have a key employee and they got killed in a car accident tomorrow, ACC is going to probably pay their family some money, but the business has now lost that person, and what happens? So, a key person contract basically says what happens if the person dies, what happens if the person is diagnosed, what if they can't come to work for 12 months. We need some money coming in as a lump sum or either on a monthly basis to compensate us a lot.
The death, Kevin, you're talking about funding equity, right?
No, that is the next question. Is that if you've got people in business, if Gareth and I were in business and our business is worth $500,000, if Gareth dies, I probably would want to buy the shares from Lisa so that she didn't want to be a business owner and vice versa. So a key person contract is designed to protect your cash flow, and a share purchase contract is designed to protect records.
Wow. Okay. Yes. So yet other considerations, right?
Yeah.
That's a good scenario too. True. Right.
And I guess jumping into that as well, Gareth, with ACC and key person, most key person contracts are not offset by ACC as well. And generally they have a minimum of a 4-week stand down. So when ACC pays after 7 days, if you're still off claim for longer than 4 weeks, your key person benefit can kick in and you get paid in addition to the ACC payments. So that's where it's quite a great contract that works cohesively with ACC. And if you have an illness, as you say, at least you get a benefit after 4 weeks, where ACC will only cover you for sickness-related events. Sorry, for accident-related events. Sorry.
Yeah, and the sickness benefit is hardly anything. So, yeah. All right.
From a technical point of view, I'm not going to try and lose anybody here, and I hope I don't. But with income protection policy, you basically have 3 styles of contracts. Key person contracts that are owned and paid for by the business itself. We have personal income protection policies that generally are offset by ACC. So if ACC pays you, the benefit is reduced by the ACC payment. And then the third type of contract is what's called mortgage repayment insurance. Now, they are not offset by ACC. So you've got to work out what type of contract you have within those boundaries, which has got so many policy wording to say what type of policy is it, who owns it, who's paying for it, and what does the policy wording say to see whether they're offset by ACC or not. Right. Whether ACC is going to pay in addition to it as well.
Yeah. Okay. Well, so that's good to know. It does kind of sound like the sort of thing where you want somebody to just sort of run their eye over what you've got to insure. It's for purpose.
Yeah.
One thing we run across sometimes is that we're doing people's tax returns and they say, "Oh, I've got income protection insurance. Can I claim this?" Right. And so we say, "Well, go back and talk to your insurer," who usually says, "Well, I don't know, ask your accountant." So that's also sort of relevant in that 9 times out of 10 it's not deductible because it's on a personal level. There's no connection with any business activity. IRDR unlikely to view it as that. Whereas key person insurance is very clearly paid by the business, tax deductible, paid out to the business, etc. So that's kind of a bit of a benefit, but I guess if it does pay out, obviously it's going to be some taxable income. So it swings and roundabouts, isn't it?
I wish it were that simple.
Yeah.
There are, on the personal income protection policy side, we can also get to the next technical level. There are agreed value contracts which are non-deductible and non-assessable. We have indemnity-based contracts where the premium is deductible, but the proceeds are accessible. They're both offset by ACC. But the biggest problem that we have with this, there are no bond according with inland revenue. So from an accountant's perspective, how would you know? And the biggest problem I see with self-employed people is that they say, oh, these are all on my business insurances because they try and get the business to pay for everything. And suddenly the accountant, I see sort of $5,000, $10,000, $15,000 of personal insurance going through the business account. And the trouble is that when you track that or something goes wrong, if the business is paying for it and a claim is made, who actually is going to be the beneficiary of it? Because it can be some tax too.
So again, if it's not set up right, it can be fraught with difficulties at claim time.
Yeah.
So it's kind of like get your foundation sorted, the right payments from the right place and so forth. Okay, yeah. So I think it reinforces more and more that just like property, for example, has got the taxes around that have got more and more complicated every year as layer upon layer of law is added, and insurance is something like that, and well, risk, shall we say. And if we can use qualified advisors, and there's a register, isn't there, a public register where you can look up and see if a person has got the qualifications and they're up to date, right?
FSPR numbers and their license criteria.
Well, basically, when somebody meets with an advisor, they should be providing them with their disclosure information. So that person can actually read through and see exactly where they're registered, what their number is, all their contact details, and heaps of other information about them as well. So they can make an informed choice about whether to use that advisor or go to someone else.
Right.
And they can also complain about that particular advisor too if they wish to do so.
Right. So if they haven't got that, then there's your sign to head for the hills, right? Drop
Probably.
like a hot potato.
Yeah,
Well,
likely.
It is a requirement for advisors now to actually give what's called disclosure to say, this is what we do, this is how we work, this is how we get paid, this is what I specialise in, this is how I get my clients. And I think that's really, really helpful anyway, because it explains everything about them and what they try and do to help the client. So I think this is a step in the right direction to help people engage with the financial services. I think it's probably the last point that I'll make on this. I know with our sophisticated clients, we're in regular communication with their lawyers and their accountants on a yearly basis anyway, because a lawyer looks at things from a legal point of view, accountants look at things from a money accounting point of view, a compliance point of view, and we look at things from a risk point of view. And so we have a different background and we look at things differently. But by putting all three of it together, you actually shorten the process down and you allow those professionals, the creative things, make sure that we're all doing the right things. And we can talk about tax and we can talk about ownership and whether they've got family trust or who should be the beneficiary of the policy. It just unearths all of those opportunities. But it's the client's responsibility to say, can you guys all talk to each other? And I think that's probably the point. Make sure your professionals talk to each other and do the right job for you.
Right. Okay, that's good advice. Now, I guess in terms of our final comments here, we had a bit of advice here, Jess, from yourself about medical insurance. If you can do it, and the younger you are, the better. Are there any sort of, I guess, the must-dos for 2022 with respect to this area of risk? If there's one thing you had to say to people, do it this year, if you haven't done already, do we have any suggestions from the team at Solutions Financial Services? I'm putting you on the spot here, of course. Yeah.
I'd probably say if you've got existing insurances in place and you haven't looked at them for a while, do it, because you just want to make sure that what you're paying for is correct for your situation. And you like, no one wants to pay for things that they don't need or that aren't going to work or anything like that. So we all just want to make sure that we're paying for the right things that are fit for our situation. So yeah, I would definitely say go and review it. And if you don't have a financial advisor, I would highly recommend finding one that you like. If you don't gel with the first one you meet, there's plenty more out there. And So just look around until you find someone that you're comfortable with, because we work with clients for years and years. Like Kevin's had clients his entire career, and he's watched them go through every stage in their life and really helped them, pave their way through life and help them to create financial wealth at the end of it. So, I mean, if you don't pay for the advice, so why would you not do it? It's a bit of a no-brainer. And also you don't have to use the advice. You could just meet with a financial advisor and say, hey, this is my situation. What would you recommend that I do? And then they'll, write you a bit of a plan, and then you can choose to implement that or not. It's up to you.
My simple advice would be to get your legal affairs in order, get your accounting affairs in order, get your banking and savings affairs in order, and make sure your insurance is fit for purpose.
That's quite a lot of work.
But if you get those 4 disciplines, or those 4 areas of your life in order, and you challenge those set of circumstances every year, that you make sure that your interest rates are right, make sure your kiwi savings is invested the right way, make sure that your assets are properly protected. Someone is showing you and guiding you on save first and spend second. We teach maths in school, but we don't teach money. So, kids are not taught to save anymore. So how are they going to end up with $200,000 or $300,000 in cash to buy their first house? Because if you have a look at the new lending rules out, we're seeing banks cancelling people's mortgage applications because they're spending too much money on their groceries.
I guess you stole my one as well, Kevin.
Yeah.
I was going to segue into that, saying if you're thinking about kind of getting your financial affairs in order, you may as well start now, because as Kevin said, financial literacy is just something that's never been taught. So setting up a savings account, plan some goals, and start working towards it, and having those good centers of influence in your life, such as a good accountant, lawyer, financial advisor, someone to help you, kind of specialists in those areas that can sort those related affairs out for you. It makes a massive difference. And sometimes you might pay a lot more for a certain accountant, but what you pay for is what you get. And having someone that can look forward and do some strategic planning rather than just doing tax returns at the end of the year might be something that's more appropriate for you and your business.
Good points. Thank you for those tips. And by the way, interestingly enough, a couple of Kiwi dads have made the Square One app to try and help parents teach their kids financial literacy. We were talking to them earlier in the week, and they made the same comment about where do children learn financial literacy. It's not being taught at schools, etc. So some good takeaways there. Hopefully one of those things, if you could even start with that, once begun is half done, as they say. Yeah, so we really appreciate those insights. Folks, the contact details for the team at Solutions will be in the blurb below. They've certainly helped us, and so that's why we're so keen to have them on the channel and to just put some of this great information out there. Thank you so much for your insights today. I think what it tells me is it doesn't have to be super hard. You can get help. It's often just make a phone call, get the ball rolling, and these little steps together can add up to a whole lot to just, I guess, bring a bit of risk down, improve your finances, etc., etc. And maybe you'll end up being a client for life as the generations go through too, because you had such a good experience. So it actually feels a little bit calming. Thank you for sharing that today.
No worries. Thank you for the opportunity.
Yeah. Well, thank you so much for joining us and sharing those insights with us today. And we look forward to hearing, a better year ahead, let's hope.
Fingers crossed.
Thank you, mate.